Imagine two empires, one built on white powder and uncontrolled cash, another raised with fantasy castles and copyrights. Both faced the same dilemma, moving millions without raising suspicions. Pablo Escobar buried cash that rotted in warehouses. Walt Disney channeled profits through subsidiaries in Luxembourg. Two strategies. One objective, making money flow. The difference is not in the amount. It is in the method. And the method defines whether you build a legacy or a tomb. This is the analysis of the art of moving millions. Section 2. The common problem. 2.0 Emachmani. There is a point where money stops being a solution and becomes a logistical problem. This is not poetry. It is pure mathematics. When income exceeds the capacity to process, store, or move it safely, wealth transforms into an operational burden. For the Medellin cartel, this problem reached absurd proportions. By the mid-80s, the organization generated estimates close to $400 million monthly in the US market alone. But that money arrived in $5, $10, and $20 bills, physical cash. No banking traceability, no invoices, no receipts. Just paper accumulating in clandestine warehouses. Pablo Escobar's brother, Roberto, declared years later that the organization lost approximately 10% of its annual profits simply because the money deteriorated. Humidity, rats, forgetfulness, bills buried on farms that were never recovered. The irony was brutal. A fortune so large it was impossible to count, store, or spend at the necessary speed. Every week, literal tons of cash entered from the United States. Clandestine flights transported packed suitcases. Maritime containers hid millions among legal merchandise. And all that flow ended in the same bottleneck: how to convert illegal money into usable assets without triggering alarms in the international financial system. On the other side of the spectrum, Walt Disney Company faced a structurally similar but legally opposite dilemma. By the late 90s and following decades, the company generated multi-million-dollar revenues in dozens of countries, theme parks in France, Japan, and Hong Kong. Global box office sales, merchandising licenses on every continent. Each operation generated massive profits, and each country demanded its share in taxes. The problem was not hiding the money, it was protecting it. When a multinational corporation generates $50 billion annually, each percentage point of taxes represents $500 million at stake. Moving those profits inefficiently means losing billions that could be reinvested in expansion, production, or strategic acquisitions. Disney could not simply leave its European profits in Europe or its Asian income in Asia. It needed to consolidate, redistribute, and optimize that capital globally. But international tax laws are labyrinths designed to retain money where it is generated. Repatriating benefits implies taxes. Transferring funds between subsidiaries triggers regulations. Each movement leaves traces that tax authorities analyze meticulously. Both empires shared the same paradox: too much money flowing too fast. One generated it from absolute illegality, the other from family entertainment. But both needed to solve the same operational puzzle: how to transform massive income into usable liquidity without losing control, without raising red flags, without bleeding capital in the process. The fundamental difference lay in the available tools. One operated in the shadows, the other under spotlights, but with tax lawyers writing the script. Section 3. The Flow Architecture. ESCOBAR. The Medellin cartel did not build a financial system. It improvised a network of desperate patches to move mountains of cash that grew faster than they could be processed. The operation generated between $20 and $30 billion annually at its highest point. But that money arrived contaminated, used, wrinkled, stained bills, money that screamed its illegal origin. The first obstacle was purely physical. $1 million in $20 bills weighs approximately 50 kilograms. It occupies the space of a large suitcase. Now multiply that by 400. Every month. The cartel needed planes, warehouses, trucks, and armies of people willing to carry cash without asking questions. The logistics of money consumed almost as many resources as cocaine production itself. The first layer of laundering began with shell companies, restaurants reporting impossible sales. Car dealerships sell dozens of vehicles daily on paper. Construction companies billing phantom projects. Taxi fleets that never picked up real passengers. Each legitimate business served as a portal to inject illegal cash into the formal banking system. But there was a limit. Depositing millions in a small account was like lighting a flare in front of the authorities. Then came smurfing. The technique consisted of fragmenting large sums into deposits under $10,000, the threshold that obligated U.S. banks to report suspicious transactions. Dozens of people, called smurfs, toured bank branches depositing amounts just under the radar, 8,000 here, 7,000 there. Hundreds of daily transactions that seemed harmless individually but added up to fortunes. The problem was speed. Even with hundreds of smurfs working simultaneously, the volume of cash exceeded the capacity to launder it. So the cartel developed the international route. Money traveled first to Panama, where compliant banks accepted massive deposits without uncomfortable questions. From there, funds jumped to Switzerland, protected by legendary banking secrecy laws. Then they bounced toward the Cayman Islands, Luxembourg, or Liechtenstein. Each jump erased a bit more of the trail, but each intermediary took their cut. Corrupt bankers demanded between 5 and 15% to process the money. Lawyers specialized in offshore structures asked for millionaire fees. Bribed customs officials needed constant payments. Each layer of protection cost a fortune. The cartel paid hundreds of millions annually just to get their own money back as usable assets. And still, the system bled. Roberto Escobar admitted they kept cash in walls, ceilings, and buried on remote farms. Billions that simply disappeared. Forgotten. Stolen by employees. Destroyed by humidity or fires. The paradox was grotesque. One of the richest criminal organizations in history lost money faster than some countries generated it. The flow was never elegant. It was chaotic, expensive, and fragile. Each transaction was a risk. Each intermediary a point of failure. And the entire system depended on maintaining absolute secrecy in a network of thousands of people. An architecture built on sand. Section 4. The Flow Architecture. Disnow. The Walt Disney Company built something the Medellin cartel could never imagine. A legal, transparent, and brutally efficient system to move billions without raising suspicions. Because when money flows within the rules, governments do not investigate. They simply watch as profits evaporate from their tax jurisdictions. The Disney empire generates income from dozens of countries simultaneously. Every ticket sold at Disneyland Paris. Every movie released in Chinese theaters. Every Mickey Mouse t-shirt sold in Tokyo. All of that produces profits that technically belong to local subsidiaries. And each country wants to collect taxes on those profits. But Disney developed a corporate architecture that turns that obligation into an optional suggestion. The strategy begins with intellectual property. The characters, the stories, the brands, the entire creative Disney universe does not belong to local operations. It belongs to corporate entities located in tax havens. Subsidiaries in Luxembourg, holdings in the Netherlands, structures in Ireland. These entities legally own the rights to Mickey, Elsa, Iron Man, and the entire catalog. Now comes the accounting magic. When Disneyland Paris sells tickets worth 500 million euros annually, that French subsidiary must pay a royalty to the Luxembourg entity for the right to use Disney characters. The royalty amount is calculated strategically, high enough to transfer most profits out of France, but reasonable enough not to seem obviously artificial. Result: Disneyland Paris reports minimal profits or even operational losses on French territory. It pays insignificant taxes. Meanwhile, the Luxembourg subsidiary receives hundreds of millions in royalties. And Luxembourg charges corporate tax rates close to 1% in certain agreements. The profit ends up where taxes are symbolic. This technique is called transfer pricing, and it is completely legal. Thousands of multinational corporations use it, but Disney perfected it into an art form. The company also employed for years the famous structure known as the double Irish with a Dutch sandwich. It worked like this. Profits flowed from operating subsidiaries to an Irish company, then passed through a Dutch entity acting as a neutral conduit, and finally landed in another Irish company fiscally registered in Bermuda or the Cayman Islands. Each jump was backed by impeccable legal contracts. Each transfer is documented to the last cent. Tax authorities could audit every movement and would find everything in order. Because the system does not hide the money. It redirects it using the same laws governments wrote. Tax savings for Disney reach billions annually. Money that is not lost paying bribes or rotting in warehouses. It is reinvested in acquiring Pixar, Marvel, Lucasfilm, 21st Century Fox. It goes toward building new theme parks, It transforms into content that generates more revenue, feeding the same cycle. Disney does not need Smurfs or clandestine planes. It needs elite tax lawyers and accountants specialized in international regulations. The cost is a fraction compared to the benefits. And the best part, everything is recorded in public annual reports. Selective transparency. The figures are there, but structured so complexly that few truly understand where the money flows. This is professional financial architecture. Cold, legal, relentless. Section 5. The straight comparison. At first glance, both systems share disturbing similarities. Both the Medellin cartel and Disney Company moved obscene amounts of money across international borders. Both used complex networks of corporate entities. Both sought to minimize losses between point A and point B. And both understood that static money is dead money. The superficial techniques seem like cousins. Escobar created shell companies to inject illegal cash. Disney creates legal subsidiaries to channel profits. Escobar moved funds between Panama, Switzerland, and the Caribbean. Disney moves benefits between Luxembourg, Ireland, and the Netherlands. Escobar paid intermediaries to process his money. Disney pays tax advisors to optimize its structure. In both cases, the final objective was the same: getting capital to its destination with the least friction possible. But here the similarities end, because the method is not just the path, it is the destination itself. The first fundamental difference is legality. Escobar operated outside the absolute legal framework. Every transaction was a crime. Every bank movement, potential evidence. Every intermediary, a witness who could become a traitor. The entire system depended on secrecy, corruption, and violence to keep functioning. Disney operates within the rules. Every transfer is documented, every subsidiary registered. Every capital flow backed by contracts that governments themselves recognize as valid. The second difference is sustainability. The cartel's model collapsed under its own weight. Authorities closed routes. Compliant banks fell under investigation. Intermediaries ended up imprisoned or dead. Each capture dismantled part of the network. Each confiscation destroyed assets. The system constantly bled and required increasing violence to stay alive. Disney, on the other hand, has been moving billions for decades with total continuity. When one jurisdiction closes a tax loophole, lawyers find another. When a country changes its laws, the structure adapts. The system evolves, it does not collapse. The third difference is operational cost. Escobar lost between 10 and 15% of his income in the laundering process, plus other enormous percentages in bribes, security, and confiscation losses. Disney invests in legal and accounting advice, but that cost represents insignificant fractions compared to the tax savings obtained. For every million invested in tax planning, the company saves tens of millions in legally avoided taxes. The fourth difference is control. The cartel depended on thousands of people keeping secrets. A single weak link could destroy everything. Disney controls every aspect of its corporate structure. Financial data is privileged information protected by confidentiality agreements. The employees handling these operations are highly trained professionals with ironclad contracts. There is no risk of betrayal because there is no crime to report. The fifth difference is legacy. Escobar's money financed a war that killed thousands. It ended up confiscated, destroyed, or lost. It built nothing lasting. Disney's optimized money built parks receiving millions of annual visitors. It financed films that defined generations. It created legitimate jobs for hundreds of thousands of people. It generated tangible value that persists decades later. Two systems to move millions. One was a desperate patch over criminal activity. The other is surgical precision financial engineering. The difference is not in scale. It is at the very foundation of the operation. Section 6. The Strategic Lessons. Capital flow is not a problem exclusive to multi-million-dollar empires. Any business generating income faces the same fundamental question: how to move money from where it is produced to where it is needed, minimizing losses along the way. The difference between doing it right or wrong defines long-term survival. The first lesson is simple but brutal. Financial improvisation costs fortunes. The Medellin cartel generated billions but lost massive percentages because it operated without structure. Every movement was reactive. Every solution, temporary. When cash flow grows without planning, chaos consumes margins. In legitimate businesses, this translates into unnecessary taxes, excessive banking commissions, poorly calculated currency conversions, or simply money trapped in accounts where it cannot be used efficiently. The second lesson deals with legal architecture. Disney does not evade taxes. It optimizes within the permitted framework. That distinction is critical. Tax authorities do not pursue those who intelligently structure their operations. They pursue those who hide, lie, or manipulate records. A small company can apply the same principle at its scale, incorporating in favorable jurisdictions, separating operating assets from investment assets, using legal deductions, structuring contracts that minimize tax burden. All legal, all documented, all sustainable. The third lesson is that poorly managed liquidity is worse than scarcity. Escobar had so much cash he literally did not know where to put it. But that money was useless if it could not be converted into usable assets. In the business world, this equals having high income but blocked cash flow, sales not collected on time, profits trapped in inventory, capital immobilized in illiquid investments. The money exists on paper, but it does not flow. And a business without flow dies even though its financial statements show profits. The fourth lesson is the value of professional advice. Disney invests millions in tax lawyers, specialized accountants, and elite financial consultants. That cost seems high until the return is calculated, billions saved annually. Even medium-sized businesses investing in adequate tax advice discover that the first year's tax savings pays for the entire consultation. The difference between a basic accountant and a tax strategist can represent 30 or 40% of net profits. The fifth lesson deals with long-term planning versus desperate solutions. The cartel operated in permanent crisis mode. Each problem was solved with urgent patches that created new problems. Disney plans decades in advance. Before launching operations in new countries, the tax structure is already designed. Before acquiring companies, the financial team models how to integrate those assets to optimize global flow. Strategy precedes action. The sixth lesson is that the method defines the final result. It is not just about how much money is generated. It is about how much is retained, how it is protected, and what is built with it. Escobar generated fortunes that evaporated in violence and confiscations. Disney generates fortunes that multiply into lasting assets. The difference is not in the capacity to make money. It is in the capacity to manage it strategically within a framework that allows growth without self-destruction. These lessons apply from the individual entrepreneur to the multinational corporation. The size changes. The principles remain. Sectfine 7. Cielosing and final reflection. Two empires, two methods, two completely opposite destinies. The Medellin cartel collapsed in December 1993 when Pablo Escobar died on a rooftop in Medellin, riddled with bullets. His estimated fortune of $30 billion evaporated. Part was confiscated by governments. Part stolen by former associates. Part simply lost in hiding places no one ever found again. The assets he built, the properties, the shell companies, everything ended up dismantled or in the hands of third parties. His family fled. His heirs received practically nothing. The most lucrative drug trafficking empire left as legacy only violence, death, and emptiness. The Walt Disney Company, on the other hand, continues expanding decades after its founder's death. Market capitalization exceeds $200 billion. Theme parks operate on 4 continents. Film productions break box office records year after year. Streaming platforms reach hundreds of millions of subscribers. The empire not only survived, it multiplied, and it will continue growing because its financial structure is built on legal foundations that allow transgenerational continuity. The difference does not lie in ambition. Both leaders were obsessive visionaries with monumental objectives. The difference is not in the capacity to generate money either. Both demonstrated extraordinary abilities to create massive capital flows. The fundamental difference is in the method chosen to handle that capital. One bet on opacity, violence, and secrecy as pillars of protection. That strategy generates explosive short-term profits but is built on sand. Each day of operation increases the risk of total collapse. Each transaction is evidence. Each partner is a potential witness. The system does not scale. It disintegrates. The other bet on legal structure, selective transparency, and long-term planning. That strategy requires patience, initial investment in professional advice, and operational discipline. But it builds empires that transcend generations. Each movement is backed by contracts. Each capital flow optimized to grow. The system does not just scale, it perfects itself over time. The lesson for any entrepreneur, business person, or investor is clear. The right path also generates wealth. It is not necessary to operate in gray zones or seek dangerous shortcuts to build significant fortunes. Intelligent optimization within the legal framework allows extraordinary results without the devastating costs of illegality. In business, as in life, the strategy chosen to move money is not a technical detail. It is the decision that defines whether a lasting legacy or an inevitable tragedy is built. If you made it this far, subscribe to the channel, activate the bell so you do not miss the next analyses, and leave your like if this content provided you with something. Share the video and tell us in the comments what other strategic confrontation you would like us to analyze. See you in the next video.